there's been a lot of concern and worry about the levels of inflation increasing. On 15th of December 2021, the Office for National Statistics stated that the inflation level, measured as CPI, was at 5.1%, which, as you can see by this chart, is pretty high. So let's talk about some ways that you can invest in 2022 to try and hedge against these high levels of inflation. And this isn't just because of the levels of inflation right now. Whether they are at 2% or 6%, you want to protect your money as much as possible against inflation. Inflation is the increase in price of goods and services within an economy over time, but specifically, it's the decrease of purchasing power. So the best way to think about inflation is to think about how far your £1 can stretch right now compared to 1 year ago, 5 years ago, 10 years ago, or even 100 years ago. For example, a loaf of bread may have cost you 1p in 1914, but then in 2014, the same loaf of bread may have cost £1.35. So this shows that your purchasing power has decreased. Obviously, you must take into account that people's earnings do go up over time, but it just shows you what inflation can do. It's really important to know about inflation because if you have money lying around, so money that's not invested, then it may be worth less in a year's time than it is today. There is also this link between interest rate and rate of inflation. So if you've got money sitting in a bank and your interest rate is 2%, but the rate of inflation is at 5%, then your purchasing power and your money will be decreasing. This shows that there's an inverse relationship between interest rate and rate of inflation. Now we know about inflation and just how inflation can eat away at our savings, it's important to think about how we can use our money to build more money over time. And this is really where investing comes in. Just a quick disclaimer, I am not a qualified financial advisor, so if you do want financial advice, please seek it from someone that is qualified. One way you can invest to beat inflation is to invest in companies that are likely to grow and survive during times of inflation. Own a piece of a company that is going to continue to make money in times of all different levels of inflation. This means that you're no longer just a consumer and you're spending more money when companies decide to increase their prices. And actually, you can make some money by being an investor. These are companies whose goods or services would still be purchased if they were to put up their prices. So think of Apple, for example. If Apple decided to raise all of their prices of their iPhones by £10 next year, people would still buy them and people would still stick with Apple because one, they trust them. They know what they're getting when they purchase Apple products. And two, Apple's designed itself in such a way that everything links and all the devices are integrated. So it would just be an absolute hassle to have to go somewhere else. Another type of company that is likely to survive and grow during times of inflation are ones offering something new, something novel, something that you can't get elsewhere. And these are the really scalable businesses. They don't have many competitors because what they're offering is not really seen anywhere else. So consumers wouldn't really have the choice of shopping around. They are going to go to that particular company. So they, again, can afford to raise their prices in times of inflation. Another way that you could possibly look to hedge against inflation is to invest in gold and or cryptocurrencies. Gold and other precious metals have been seen for a long time to be a good hedge against inflation, and this is because they're seen as a store of value. This means that there's a finite supply of it. You can't just print more or magic more out of thin air. I wouldn't say that gold is the perfect protection against inflation, as there has been times that we've seen where inflation has increased and the price of gold has gone down. But on average, when inflation increases, the price of gold also goes up. Thinking about something with a physical finite supply in existence being something good to own against inflation leads you to think about cryptocurrency. Bitcoin could be viewed as an alternative to gold, the new gold, if you will. Obviously, with decentralized money like Bitcoin, we just don't have the history to really show us how it stands against inflation at the moment. Crypto is extremely volatile, meaning that it has a lot of potential compared to other asset classes, but it does carry its own risks. The next one is a really simple one, and that is just to invest in the stock market as a whole. Diversifying and investing in different economic markets all around the world is quite advised when trying to protect your money against inflation, because it's very unlikely that every economy in the world is going to experience the same inflation at the same time. So investing in the world reduces your risk and just allows you some balance. Going one step further with this and really simplifying it, you could just invest in some funds that have done well over time. So historically strong indexes like the S&P 500 or other indexes could be a good way to hedge against inflation, because as long as the returns on them are averaging higher than the rate of inflation, then it's more beneficial to put your money into these rather than leaving it in cash or in a bank. On average, the S&P 500 returns around 7%. So one year it may be down by -2%, but another year it may be up by 9%. So on average, about 7%. And as long as this is higher than the rate of inflation, you're winning. The next way is through government bonds, called gilts. Investing in gilts is basically you agreeing to pay a certain amount of money to the UK government for a specified time period. And in return, they will pay you interest in the form of what is called a coupon, but also they will return the original amount of money that you gave to them. The money that you earn from investing in bonds is quite low, but also the risk is low. Anyway, you can also invest in inflation-linked gilts. These are just like normal gilts, but the interest rate or coupon amount is linked to inflation. So if inflation rises, the amount that you're getting paid to you in interest or these coupons will also increase. For example, Vanguard actually has one of these, and their one is called the UK Inflation-Linked Gilt Index Fund. So you could potentially look to invest in this. And the final way that you could look to combat inflation is to invest in real estate investment trusts. These are corporations that own and manage real estate. So this could be commercial properties, retail, residential, and even hotels. REITs issue units, much like stock shares, that give investors access to the income generated by the REIT's property portfolio. And this means that you can invest in them. Okay, cool. But why would you want to invest in this asset class? Well, it's because generally, when inflation rises, the price of real estate also rises. Now, this is generally not guaranteed. Additionally, landlords can put their rent up. So if you had exposure to this asset class, then you would benefit here as well. Also, outside of REITs, but in keeping with the real estate theme, you could look to invest in some stocks like Rightmove. Rightmove, in case you didn't know, is the UK's largest property website, and they are the dominant ones in the market. So going back to what I was saying earlier about investing in companies that could survive periods of inflation, they may also be one, possibly alongside Zoopla and On the Market. I think I'll actually do a video all about REITs soon, because they were an asset class I wasn't really aware of up until recently, and they are very interesting. So those were 6 ways that you could invest to hedge against inflation. I really hope this video was useful. Please don't forget to like and subscribe to the channel, and I'll see you next time.